Welcome back, and we have with us Amit Premchandani, who is the Senior Vice President and Fund Manager Equity at UTI Mutual Fund. Amit, great having you. Let me first set the context. Of course, we've got a slew of earnings that have come through. What's really standing out? Let me try and get that from you first. Within the entire earnings basket, anything that's really stood out for you this time around?
Thanks for the question. As far as earnings are concerned, overall, if you look at banking as a sector, especially the bank part of the BFSI, have seen earnings which are relatively better than expectation. Loan growth has revived. In some cases, it is almost now at mid-teens. Deposit growth is still lagging, but it will hopefully catch up. Margin, which was expected to be a negative surprise, has held on well. Asset quality, which a few quarters back was a concern in select pockets of unsecured loan and MSME, has again recovered. Slippages are significantly lower than expectation. Credit costs are normal. So the ROA and ROE profile of banks have sustained at high levels, and growth is expected to further accelerate going forward, given the monetary policy is in favor of growth. So banking is one sector where we have seen positive surprises. Automobile is another sector where we see continuous acceleration in growth even after the GST related bump up. Even in the month of December and January, we have seen a decent growth, particularly in passenger vehicle segment, which is underpenetrated as far as the Indian population is concerned. If you compare India as compared to the global large economies, passenger vehicle is one part where we are severely underpenetrated, and the numbers are also slightly better than expectations. So this is another sector where we are positively surprised. And even in the two-wheeler space, earning growth has been surprising positively. So overall, auto is another sector where we have seen positive earning momentum. One sector which is showing early signs of turnaround is the durable segment. I'm sure you are aware, and the audience is aware that last year summer was really bad for the durable sector because there were unseasonal rain in large part of the summer, and there was an inventory overhang which has mostly got cleared out. So if we see a decent summer, we can expect improvement in durables earning. Also, it's a late stage real estate cycle play. So as real estate has picked up significantly over the last 5 years, and it is on the verge of completion and delivery to the end customer, you will see a sharp increase in the low ticket durable kind of segment, which is a late cycle beneficiary. This sector has also seen very high competition over the last 4 or 5 years. We also see early signs of stabilization in that segment in terms of competition. So durable is one contra a sector where we are also seeing early signs of bottoming out.
Interesting, Amit. And durables, on the raw material side of things, you're still seeing pressure, right? So for the likes of copper, at least all the metals as well, you are seeing pressure from the raw material side of things. So margins, when do you see that recover? Okay, so you're expecting demand to come back, but pricing, is there bandwidth to increase prices? And how should one look at margins over there? How will that shape up?
Margins are already at a significant lower level. If you look at our last few years' averages, margins have already corrected significantly, largely on account of operating leverage. When the growth is low, margins have kind of got impacted because of that. So as growth revives, the ability to take price hike and ability to pass on the inflationary impact of commodities also go up. And as volume growth revives, we think that some of the players will also start to pass on the recent price hikes which we have seen. Uh, if you look at some of the some of the cables and wire players uh, have actually seen margin expansion over the last few years, despite increase in the commodity prices. and they have been actually a beneficiary of the commodity price increase.
Hmm, very interesting. And Amit, when does this thesis, if this were to play out, what would be the initial signs? You're already seeing green shoots, but what would be the confirmed signs that this will likely play out, and how long will the cycle last, in your opinion? Because if there is a if there is, say, an investor looking to invest at this point, he'd also want to know how long will this cycle last for.
It's very difficult to make a guess of the horizon of the cycle. But at the moment, what we are looking at is the base of many of the durable companies is low. We expect expansion in terms of volume growth and some price uptick led margin uptick in the next few quarters. And there will be final delivery of homes to the end consumer, which will again drive demand of these durable as a sector. How long that cycle will continue is subject to various factors, and some of it is seasonal, and it's very difficult to predict seasons.
That it sure is. But it surely, Amit, seems to be turning out a good season for consumption per se. I know you talked about consumer durables as well as autos. Other than that, staples, some of the niche consumption plays, they too are propping up this time around. We were just looking at some of the QSR numbers, etc. as well. It pretty much seems to be an across the board theme.
Yeah, so thanks for the question. Post the GST cut, you have seen first improvement in discretionary consumption. The impact of the GST cut was much more visible in large ticket items. And now you are seeing a gradual pickup in a lower ticket consumer discretionary item. That may also be a first sign of urban consumption picking up. As you may recall that over the last 2 years, we have seen commentary from various staple and consumer companies that actually rural growth has been better than urban, and especially over the last 1.5 years, urban consumption had slowed down. Post the GST cut, we may be seeing early signs of pickup in urban consumption. As far as staple as a sector is concerned, I'm kind of relatively more neutral on that because most of the products in that sector are largely penetrated. We are focused more in terms of investing in companies which are exposed to sectors which are relatively less penetrated as far as per capita penetration is concerned.
Uh, Amit, you know, always a studio conversation, which we need to spill over to you as well. You know, PSU banks, they've been rank outperformers, you know, all through the last few years. And, you know, the leader in that pack continues to do extremely well. The numbers were very, very strong. And this is across the board. Uh, are they ripe for a re-rating in the sense they currently, most of them still trade at one-time book? Do you believe a 1.5 time book would be warranted on some of the PSU banking counters or not so much?
Very interesting question, and it's a question we deal with every day. Uh, PSU banks have not seen this kind of valuation, if you recall, except for the 2010-12 rally, when they had very high loan growth, and their ROA profile was also almost at par with private sector banks. Over the last 3-4 years, what we have seen is that naysayers have been writing off PSU banks, and they have been consistently reporting decent ROA and ROE outcome, especially over the last 2 years when the benefit of the recovery-led P&L benefits, because they had a very large written-off pool, they were getting significant benefit from recovery of that written-off accounts in the P&L and reporting high ROA, ROE. But that benefit has consistently gone down over the last 2 years, and in recent quarters, that benefit is very patchy or very limited. And despite that, they are reporting decent ROA and ROE outcome. And in some cases, some of the large PSU banks have loan book growth, which is significantly higher than private sector bank. But private sector banks continue to have a much higher ROA profile as compared to the leading private sector banks as compared to PSU banks. So we actually do have stopped looking at it from the lens of ownership, and we have started looking at it from the lens of what is the outcome, what are the outcomes in terms of growth, asset quality, and return ratios. And some of the PSU banks clearly stand out. As far as re-rating is concerned, I'm sure you are aware and audience is aware, many large private sector banks have seen except for few, have seen significant derating over the last half a decade in terms of multiple. So the gap between leading private sector banks and leading PSU bank is now pretty low.
Right. Okay, Amit, great to be chatting with you, but hold on to that thought. We're going to take a very quick break and come right back and continue discussing markets with you.
So, okay, a percent or so higher on the back of all that's playing out with regard to insurance, but surely something to keep our eye out on. Let me go back to Amit. Amit's still with us. Amit Premchandani of UTI Mutual Fund. Amit, I wonder where you sit on with regard to the IT and the traditional Indian IT companies debate. Existential crisis or a large opportunity possibly waiting for them. In your view, where do we sit?
So it's a very tricky time to answer that question. The we have significant exposure to IT as a sector, and our thought process is that it's a very high free cash flow generating sector, which distributes large part of the cash it generates to the investors in the form of dividend or buyback. The sector has gone through 2.5 years of almost very low growth, and we have seen last 2 quarters early signs of revival, especially in terms of deal momentum. There have been increase in deal wins and the bleeding of the sector in terms of reduction in the past growth, past revenue through the form of passing on of productivity gains has reduced, and we are expecting the recent deal wins to reflect in revenue growth going forward. The last 2 quarters have also seen marginal upgrades in estimates for IT services as a sector. Some part of it driven by the currency depreciation, and some part of it because of the very low expectation that we have already built. Now, what has happened in the last fortnight is that uh, the market is concerned about the terminal value of this sector, given what is happening globally in terms of artificial intelligence and its application. At the moment, we think that when it comes to implementation of artificial intelligence in an enterprise environment, you required IT services companies for that transition. And in the initial phase, IT services companies will be a net loser because of passing on the productivity benefits. But in the second phase, we still expect IT services companies will be required to implement this transition to artificial intelligence in an enterprise architecture environment. There are many layers in an enterprise architecture in the enterprise environment, and integrating all these layers with AI requires a very different mindset, a different understanding of the complexity of an enterprise, and for that reason, we think IT services companies would be required. But the last 1 or 2 weeks has raised some concerns in terms of the terminal value of some of the headcount-driven businesses.
Okay, Amit, great to have you today on the show and join in with your thoughts on the markets in various sectors. Good speaking with you.
Thank you.
Okay, let's take a very quick break on that note. Still quiet and flat for the market. The market breath is well even Steven. We'll track the last lap of today's trade, but after this short break.